Wall Street just reacted to the Federal Reserve's latest decision, and the ripple effects are being felt not only in the United States, but also across the UK, Australia, and Canada. But what exactly happened? Why does it matter? And what does it mean for you? Let's break the story down. First, let's quickly remind ourselves what the Federal Reserve, or the Fed, actually does. Think of the Fed as the financial heartbeat of the U.S. economy. Their main mission is to keep prices stable and unemployment low. And one of their most powerful tools is something we all feel every day: interest rates. When the Fed raises interest rates, borrowing money becomes more expensive. Credit cards, car loans, student loans, and mortgages all cost more. That usually slows down spending, and in theory, it cools inflation. But on the flip side, it can also slow economic growth and make it harder for businesses and families to borrow. When the Fed cuts rates, the opposite happens. Borrowing gets cheaper, people and businesses spend more, and growth picks up. But too much cheap money for too long can fuel inflation, bubbles, and risky behavior in markets. Now, this week the Fed decided to insert actual decision here: raise, pause, or cut rates. The moment the announcement came out, markets reacted instantly. In the US, the Dow Jones and S&P 500 swung sharply as investors tried to figure out what this decision means for the months ahead. Tech stocks, which usually react strongly to interest rate moves, saw big shifts. Across the Atlantic, the Bank of England signaled that it's watching closely, because US interest rate hikes tend to strengthen the dollar and put pressure on the pound. For the UK, that can mean higher import costs and more strain on an economy already facing inflation challenges. In Australia, the ASX dropped as traders speculated whether the Reserve Bank of Australia will follow in the Fed's footsteps. And in Canada, rising US rates often push the Bank of Canada toward similar decisions, which means higher mortgage rates and more stress for homeowners already dealing with expensive housing markets. So, let's talk about the bigger picture. What does this all mean for everyday people? For borrowers, it means higher payments on credit cards, cars, and mortgages. For businesses, it means higher costs to borrow money for expansion or hiring. For investors, it means stock markets could face more volatility. And for global trade, a stronger dollar can impact currencies in the UK, Australia, and Canada, making imports more expensive. To put it into perspective, this isn't the first time the Fed has made a move like this. Back in 2008, decisions about interest rates shaped the financial crisis. In 2020, massive rate cuts were part of the emergency response to the pandemic. Every single rate change tells a story. And this one could shape the path of the global economy for years to come. So, what should you take away from all this? If you're in the US, UK, Australia, or Canada, the story is clear. Borrowing is going to stay expensive. Markets will likely stay bumpy, and inflation remains the #1 thing to watch. The next big chapter comes with the latest inflation numbers expected next week, and that could determine what the Fed does next. Every market move has a story, and here on Money Stories, we'll keep breaking them down for you in simple, clear language. Make sure to hit subscribe so you don't miss the next chapter.